Hey, Bert Salazar here. Hope all of you are doing well. Last week I did a short video on the importance of a life insurance audit. And then I want to talk a little bit today about an audit that I just completed almost 2 weeks ago. And this is a husband and wife that came to me based on one of the seminars that I conducted at a local university here in South Florida. And they wanted to do a review and assessment of their insurance and their investments and so forth. So I went ahead and reviewed two life insurance policies that they owned. They're in their early 50s, and they bought two life insurance policies from a very reputable life insurance company. You know, one of the things that I like to say to all of you is that the vast majority of life insurance companies in the United States are very, very good at what they do. The biggest challenge is how do you design the contract based on the goals, objectives, and needs that the clients may have individually. So in this case, they have bought two whole life policies, which are very, very good policies. But then again, it did not fit the profile of what they wanted to do with those policies, and the growth of those contracts were not fast enough or at a fast enough pace for them to be able to catch up, because they have pretty much started late as far as saving for retirement and so forth. So when I reviewed these two policies, for each, they're paying north of $6,000 a year. The death benefit on the whole life contracts was $300,000 on one and $325,000 on the other. And according to the information that I received from the clients, the agent that sold them these contracts said that the company had been paying somewhere between a 7 to a 7.5% interest every single year. Now, immediately for me, having been in this industry for 30 years, that was an enormous red flag that I picked up right away. But I went ahead and said, well, you know, send me the information. Let's take a look at the illustrations. Let's do some in-force illustrations on that as well. And when I completed doing my job, I realized, number one, that the whole life policies that they had purchased was one of the old policies that did not have the long-term care riders, you know, the chronic and the critical illness riders that are so prevalent and so important today in the new contracts that Americans are purchasing every single day. The other thing that I noticed is that after 10 years of putting $6,000 on each contract, the internal rate of return cash on cash in the contract, in other words, in the cash value of the contract, was a negative 6.74%. So for the first 10 years of the contract, there was a negative cash flow of 6.74%. So obviously not that 7 to 7.5% that the agent had apparently told the clients. After 20 years and doing the same internal rate of return, it was a positive return over 20 years, but it was only 1.2% rate of return. Now, how do you think you're going to be able to make it to retirement? You know, one of the main questions that I ask the clients is, you know, what do you want this contract for? And the clients basically said, you know, Bert, we need the protection. You know, we have a child that we need to protect. We want to protect each other in case of a premature death. So that made all the sense in the world to me. But by the same token, we want to use these contracts as a supplemental retirement plan. And then when I brought to them the issue of the negative 6.74% in the first 10 years, and the positive of 1.2% in 20 years, and I asked them, do you think it's going to be enough? They got very upset. Not at me, they didn't get upset at me, but they got upset at themselves and the agent that had sold these contracts to them, because they should have known better. Just by doing the rule of 72 or doing some quick math, you would know that there was no way that these clients would be generating 7 to 7.5% return on their cash value from day one. So that's, again, something that, you know, I don't know what the agent said. You know, obviously I want to give credit where credit is due. The company's a very good company. The product is very good. The product was just not the suitable product for the client. So I went ahead and did the audit, and then I went out into the marketplace and identify a company that would be able to repair and kind of put them in a much, much better position than they would otherwise. The other challenge that the clients had with the whole life is that they couldn't understand and they couldn't see how much money was going toward the cost of insurance versus toward cash value. In a traditional whole life policy, you're never going to know that because it's all bundled together. So in what I put together for them, I went to a very reputable carrier. I was able to check this out. This is very, very important for all of you just watching this short video. I was able to take them from a $300,000 and a $325,000 death benefit to a $400,000 death benefit guaranteed until age 95, and the clients are in their early 50s. So it was a tremendous product compared to what they had. Most important, the new product has a long-term care rider feature that provides chronic, critical, and terminal illness protection riders similar to long-term care riders that you would find anywhere out in the marketplace that the current contract that they owned did not provide. In addition to that, I was able to reduce their cost by over 60%. For one of the clients, the cost of buying more insurance with all the additional long-term care riders was about $3,000 a year compared to $6,200. And then for the other client, it was like $2,700. The wife, it was $2,700 compared to almost $6,000. What could they do with the rest of the money? Well, now, if they do proper tax planning every single year, they can take the difference between what they were paying in premium to the current company versus the new premium for the new contract, and then decipher whether that money was going to go into a traditional IRA, whether the money was going to go into a Roth IRA, whether the money would go into a combination of both, whether because of the fact that they own a small company, could we set up a simple IRA, giving them the ability to put more money into their Roth IRA or traditional IRA, because in traditional IRAs or Roth, you're capped at $7,000 altogether. So it would give these clients a tremendous amount of flexibility while providing the guarantees and making certain that they would be protecting the risk of dying too soon, and most important, the risk of living with a disability at a 60% reduction in cost compared to what they were paying before, and they weren't even getting the rider for the long-term care benefit protection and so forth. So that is why having a life insurance audit done on a regular basis is so critically important for the vast majority of Americans. So again, if you have any questions or if you feel that I could help you in putting together a life insurance audit, please feel free to reach out to me. Area code 786-766-1042. Let me repeat that again. Area code 786-766-1042. You can also send me an email, and you can send it to Bert, B-E-R-T, at gablestaxgroup.com. And always remember that my goal with each and every one of you is to help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time, and I'll talk to you soon. Take care. Bye-bye. Have a great day.